Welcome to the deep dive. Today we're zeroing in on JFrog, ticker FROG, and their first quarter earnings for 2025.
That's right.
We've got the official announcement, some news articles summarizing things, and a bit of a feel for the market reaction.
hmm
Our mission really is to cut through the financial noise and just pull out the key insights for you, figure out what's really important here.
And JFrog, it's an interesting company. The name apparently comes from the founders liking frogs, which is kind of fun.
Hey, okay.
But yeah, they offer this software as a service platform. It's all about streamlining software development and release, making it faster, especially for bigger teams.
Right.
They're aiming high too. They talk about being the software system of record. So basically trying to unify DevOps, DevSecOps, and now even MLOps.
That's a big ambition, like a single pane of glass for everything software related.
Pretty much.
Yeah.
Instead of juggling different tools for coding, security, AI models,
Mm.
they want it all managed in one place. Think efficiency, visibility, security benefits.
Okay, so let's unpack this Q1 report. The initial headline seems, well, pretty good, right? They beat revenue expectations, showed decent year-over-year growth,
Definitely.
but like you hinted, the market reaction seems a bit, cautious, maybe?
Yeah, a little nuance. So
Yeah.
let's dig into the actual numbers and maybe see what's driving both the results and that investor sentiment.
All right, let's start with the positives, the wins. Where did they really shine?
Okay, so revenue first. Came in at $122.4 million. That's up a solid 22% from the same quarter last year.
And significantly better than expected, wasn't it?
Exactly. Analysts were looking for about $117.3 million. So JFrog beat that by, what, 4.4%? It's a decent beat.
That is decent. And it wasn't just revenue. The earnings look strong, too.
Yeah, the bottom line held up well. Non-GAAP earnings per share, the EPS figure everyone watches, was $0.20.
And the prediction was?
Predictions were around 0.16 cents. So that's a pretty substantial beat, over 21%.
Wow, okay.
And their adjusted operating income also came in strong, $21.35 million against estimates of about $17 million. That's a 25% beat there, giving them a 17.4% margin on that adjusted basis.
So hitting the marks on those key metrics, what about the cloud side? That's always a focus for SaaS companies.
Oh yeah, cloud growth was really impressive, up 42% year over year. That brought cloud revenue to $52.6 million.
42%, that's significant.
It really is. And it means cloud now makes up 43% of their total revenue. That's up from 37% last year. So the shift to cloud is definitely accelerating.
Which presumably gives them confidence looking forward. Did they raise their guidance for the full year?
They did, slightly. Full year revenue guidance midpoint is now $502.5 million, just up from $501 million before.
Okay.
And the full year adjusted EPS guidance also got a little bump to $0.69, which is also slightly ahead of what analysts were expecting.
All right. Now, for a subscription business like this, keeping customers and getting them to spend more is crucial. How's that net revenue retention looking?
Still looking strong. It's at 116%.
So explain that 116% for us. What does that actually mean?
It means that if you take the pool of customers they had a year ago, that same group is now spending 16% more this year. So they're not just staying, they're expanding their usage, buying more services. It really points towards, customer satisfaction and them getting more value over time.
That makes sense. And are they landing bigger fish, too? Getting more high-value customers?
Seems like it. The number of customers paying over $100,000 a year is now over 1,000, 1,051 to be precise.
Okay.
And maybe even more impressive, the number paying over $1 million a year, their ARR, reached 54. That specific group grew 35% year over year.
35% growth in million-dollar customers. That's quite something. Shows they're getting traction in large enterprises.
I don't suggest that. And one last positive point. Free cash flow is healthy at $28.1 million.
Healthy, but was there a slight catch there? I thought I saw something about the margin.
Ah, yes. Good point. While the dollar amount is healthy, the free cash flow margin actually decreased from the previous quarter. It was 23% this quarter, down from nearly 42% in Q4.
Okay, so it's still positive cash flow, but maybe not as efficient conversion as the last quarter. Something to watch.
Exactly. Still a win overall, but with that small caveat.
Right. So that covers the main highlights, the clear wins. But as we mentioned, it wasn't all sunshine. Where were the areas that might, give investors a bit of pause?
Well, despite the strong adjusted operating income, if you look at the standard GAAP operating margin, it was actually negative 18.8%.
And that's worse than last year.
Slightly worse, yeah. It was negative 16.6% in Q1 last year. So on a GAAP basis, expenses are still growing a bit faster than revenue.
Okay, that's one point. And we already touched on the free cash flow margin dip. Anything else?
There was a mention in at least one report about a potential slowdown in signing new large contracts.
Ah, okay. So maybe the growth in existing big customers is strong, but landing brand new ones slowed down a bit.
That seems to be the suggestion. And those big new deals are obviously important for future growth momentum, so any perceived slowdown there could definitely make the market a bit nervous.
Right, that makes sense. So those factors, the game margin, the free cash flow margin dip, maybe slower new large deals, could explain why the stock didn't pop significantly on the headline beats.
It's very possible, yeah. It points to the complexity of market reactions.
Okay, let's shift gears a bit to strategy. We know the numbers, some concerns. What's JFrog focusing on moving forward?
Well, a big push is getting customers onto their full platform, the Enterprise Plus subscription.
Right, you mentioned that earlier.
Yeah, and it seems to be working. 55% of their total revenue now comes from those subscriptions, up from 49% last year. So customers are increasingly buying the whole package deal.
That validates their integrated platform strategy, I suppose.
I think so. And then the really big strategic news is their move into MLOps.
Machine learning operations. Tell us more about that. They launched something called JFrog ML.
That's it. They've integrated MLOs capabilities right into their platform. So MLOs is basically trying to bring that DevOps discipline, automation, monitoring, management to the world of machine learning models.
So managing AI models, just like you manage software code.
Exactly. As AI becomes embedded in more software, managing those models, their versions, their security, it becomes critical. JFrog wants their platform to be the place where you manage both your traditional software and your AI components. It's about unifying those workflows.
That sounds like a pretty smart, forward-looking move, given where tech is heading.
It seems like it. And they're thinking about the security angle, too. They announced a partnership with Hugging Face.
Oh, the big AI model hub.
Yeah, precisely. The partnership is focused on improving the security of the machine learning models hosted there and used through JFrog. So addressing a key concern in the AI space proactively.
That's interesting. Beyond product, are they doing other things to position themselves, like thought leadership?
Yeah, they just released their annual Software Supply Chain State of the Union report. Doing things like that helps establish them as experts, keeps their name associated with the key trends and challenges in the industry.
Okay. And what about their own forecast for the immediate next quarter, Q2?
Their guidance for Q2 revenue is around $122.5 million at the midpoint. That's actually slightly above what analysts are currently expecting.
So they're signaling continued growth momentum into the next quarter.
Seems that way, yes.
All right, so we've got the results, the strategy. Let's circle back to that market reaction. The stock dipped slightly, like 3% after the announcement.
Yeah.
Despite the beats on revenue and EPS and the positive cloud growth. So it really does seem like the market might have been focusing on those margin figures or maybe that potential slowdown in new big contracts.
It certainly seems plausible. Or maybe expectations were just incredibly high going into the report.
Yeah.
Sometimes even a good report isn't good enough if the whisper number on the street was even higher.
True.
But yeah, those concerns about JAP profitability, maybe the rate of new logo acquisition at the high end, those are definitely the kind of things that can temper enthusiasm, even with strong top-line growth. It just shows that exceeding some expectations doesn't guarantee a stock bump.
It really highlights that disconnect that can happen. Okay, so stepping back, what's the big picture here? The fundamental why behind JFrog's performance and strategy?
Well, the CEO talks a lot about their platform being critical infrastructure for the software supply chain. This idea of being the system of record for DevOps, DevSecOps, and now MLOps.
And the growth numbers seem to back that up over time.
Yeah, if you look at the last 3 years, they've had a compounded annual growth rate of 26%. That shows pretty sustained demand for what they offer.
And that strong net revenue retention, the 116%, reinforces that customers who are finding value and sticking around, even spending more.
Exactly. That's a huge validator. Right. So you combine that customer satisfaction with their strategic focus on cloud and this timely push into MLOps.
Yeah.
It positions them pretty well, you'd think, to ride some major trends in software development.
Okay, so let's try and wrap this up. What are the main takeaways for you from this deep dive into JFrog's Q1?
I'd say JFrog definitely delivered a strong quarter overall. They beat expectations on revenue and earnings, showed really impressive cloud growth. That's the good news.
Right.
The strategic moves, especially launching JFrog ML and the Hugging Face partnership, show they're innovating and looking ahead. That's also positive. But yeah, the market reaction was a bit muted, and that likely points to some underlying concerns, probably around those gap margins, maybe the free cash flow margin dip, and that potential slowing in new large contract wins.
So for you, our listener, hopefully you've now got a clearer, more rounded picture of JFrog, going beyond just the headlines to understand the performance, the strategy, and maybe why the market reacted the way it did. It gives you a much more informed perspective, right?
Absolutely. And it leaves us with a question to think about, doesn't it? Given JFrog's focus on that whole software supply chain, now including AI and MLOps, how does their platform need to evolve next to become truly indispensable, especially as AI gets woven deeper into everything?
What are the big challenges and maybe the big opportunities for them in this really fast-changing tech world? Something for you to ponder.